Before we move on, just want to pull up the Maruti stock. Those numbers look quite good. They almost clocked 200,000 units in a single month. That's a big growth if you look at it on a year-on-year basis. It's close to around 15% growth on a year-on-year basis. So that's looking quite good. Exports on a low base, well, very strong, though. That's up close to around 37%. And domestic sales as well, up in the early teens, up close to around 13%. That explains why Maruti now is one of the biggest gainers, speeding away as we speak. But let's welcome our next panel. We have Sandeep Bhatia of Macquarie, Deven, Choksey, as well as Gautam Trivedi of Nepean Capital, who joins us on the show. Good afternoon, gentlemen, and thanks so much for joining in. Well, Gautam, let me put this question across to you. And my colleague Hormus was just talking about these railway stocks flying away. And maybe, in fact, now they're a little bit disappointed because we were prepared for an interim budget, but maybe the street was hoping for something more. What's your view on this entire railway as well as defense theme? Because both those two pockets are a little bit soft today, though they've seen a big run in the last 12 to 18 months.
Well, I think to your point, Nigel, the run in the last 12 to 18 months itself has played out very well and is factoring in a lot of more, I would say factoring in as much as FY26 into the numbers in terms of the way these stocks have run up. So I think given the fact that, yes, I think that the push from the government for both these sectors still remains very strong. But the fact is, I think profit booking at some point was necessary, and I think that's exactly what's happening. Nothing has otherwise significantly changed from an order standpoint, at least not in the budget.
Sandeep, the question for you is that is there anything in the budget which changes your investment narrative? Would you be making any changes in your portfolio? Weightages up, weightages down, in, out, based on what we've heard?
I think this budget essentially gives me the message that India is in a long-term growth path with actually lower interest rates than would be for most Western countries. The consolidation in the fiscal deficit consolidation is a very good thing, and India has been on this path for at least 3 years. India did a lot of right things, especially post-COVID, because we didn't spend as much. The US, the largest economy in the world, is actually cranking up a fiscal deficit. It is not able to control its inflation as much. India, on the other hand, has controlled fiscal deficit and continues to be the largest large economy, which is the fastest growing economy. If you look at this just 3 years, if you project this 3 years on, assuming the same kind of policies continue, after the elections, India's entire consumption, durable, banking sector will all be for a massive positive benefit. We've seen some benefit come through in Maruti, in autos. Interest rates will continue to trend down. There would definitely be, therefore, better lending. Corporates will also benefit. Currency will remain stable. So I think it actually shows you what can be done if we have a stable policy, and that continues for the next 3 to 5 years, which I hope will happen.
All right. Hi, Sandeep. Good afternoon. Nigel on this side. The street was bracing for this mid-teens earnings growth. Suddenly it appears some of these banking names a little bit under pressure. Could be just in the near term, not a big structural change. But give and take everything that we've seen from the banking names, is that earnings growth at risk that we are factoring in for FY25?
I think near-term earnings growth will be at risk. I think there was a lot of anticipation that this kind of positive cycle will continue. I think there's been a bit of a hiccup there. But if this fiscal deficit consolidation cycle continues, I think public sector banks are the largest beneficiaries. SBI is a beneficiary there. The private sector banks, I think they may not be as clearly a beneficiary as the public sector banks, because most people think the public sector banks are very short cycle. So the benefit to the public sector banks potentially is higher, because this could be a longer cycle benefit for public sector banks.
I want to extend this debate around banks with the rest of the panel as well. So let me bring in Deven. Deven, good afternoon. Good to have you on the show too. So initial thoughts, of course, on the interim budget or any specific takeaways. And then really the question to both you and to Gautam, because I think this banking dilemma is the immediate sort of issue before the market in the near term right now. And I want to get both of your sort of comments and thoughts on this, and whether this is just a passing phase, whether we're making too much of it, or whether this could become a bit of a slightly more important hiccup that the market can't ignore. Deven? Deven, I think you're on mute.
Okay,
I think while we fix that, Gautam, let me take that question to you in the meantime. You know, banks, and really, I don't think the street was prepared for any kind of sort of disruption at the end of the third quarter. Maybe just some minor compression on margins, but what we've got are bigger questions than that. How do you see it?
Fair question you raised, given the fact that I think the government still, whether we like it or not, seems to be still the biggest spender in terms of whether it's infrastructure and doling out subsidies, etc. So the bulk of the capex is still being shouldered by the government of India. Unfortunately, we've not seen that pick up as yet in the private sector, which we've been waiting for the last at least 2 to 3 years. So the fact is that on the corporate lending side, you don't see that pickup. Almost every second promoter that I meet ends up saying, I want to get to net debt zero. So there is some sort of a race to get to net debt zero in the hope that, that basically we end up having better cash flows. The market ends up re-rating our stock price. And the burden of debt, which is unfortunately, the wrong way to look at it, because every company should be having a judicious mix of debt and equity. But there seems to be some aversion even now to debt, given what's happened to some of the over-leveraged companies. So given that backdrop, the question I have is that will banks be focusing still and competing with each other more on the retail side and less on the corporate borrowing side, which is the government doesn't come to banks to borrow, the private sector does.
All right. Gautam, I think we had this chat a couple of weeks ago and we spoke about various other financials. And I think IRFC as well was another stock that we had discussed at that point of time. And I think you were still fairly positive on it. And after the big run, the stock did even better. What's your view on that? And how do you look at the other financial themes?
I think IRFC is a unique case. And again, not all of them have performed as well as it has. So my view is that, continue holding something that's performing for you versus trying to sell something, a book profit. And because then what do you do with the money, given exactly what Sandeep said, that, the next, few years for India look extremely sound from a fiscal standpoint, from a corporate earnings standpoint, and political stability standpoint. So given all of these factors, I think, my view to people is if you made money in a stock, even if it's made 2 or 3x for you, but if the runway is still strong, you're still looking at a 20 to 30% top line CAGR, earnings CAGR, hold on to these stocks. Don't sell them.
Sandeep, L&T is the poster boy of India's infrastructure spend, Capex spend, but the company is struggling when it comes to its numbers and the old legacy orders. Thoughts on L&T from here on?
So L&T is a very complex entity, and it essentially has multiple parts to it. The large part, which is sort of still growing strong, is of course the international orders, and the domestic orders are also there. I would think it is a slow burn situation, as pointed out by Gautam. The Capex cycle is coming in much later than what people thought it would come in at. So on L&T, I think there's still some time, and the wait would be a year. In the interim, please watch out for geopolitical movements. We have seen that, time and again, the construction companies, especially for international orders, face pressure when there are some negative developments overseas where they are operating and the projects get impacted. So I would be careful about that. So I would still think the best stories would be India domestic, especially in the manufacturing and Capex side.
So, Sandeep, just to expand on that point, since you're still optimistic on manufacturing and Capex, just complete that point on banks as well. And what's your own thought? Gautam raised a very, very, very interesting perspective. And it's true, 10 years back, everybody was, over leveraged and everybody wanted to expand. And today we're in the polar opposite, world. So in that context, how are you looking at large cap financials, and what do we do with the historic high price to book multiples? I mean, do you see them coming back?
So if this current fiscal path continues, India will benefit from longer term lower interest rates. Consumers will benefit from lower term interest rates. The most important statement which Gautam made was the attitude of businessmen is still to cut debt. Right. And that is a fact which we all witness. And the memories of what happened in 2012, 13, 14 are still fresh in the minds of people. I would think if we see this fiscal consolidation happen, there would be therefore a mix of debt and equity coming through. Today, equity looks extremely cheap because the PEs are very high, and we can see capital raising happening. A bit of semblance of correction, therefore, in the market will actually help companies to look at raising some more debt rather than just depend only on equity or so on. So I would think wait for 6 to 12 months. Capex definitely will pick up. There's no doubt about that in my mind. But whether it gets funded entirely by equity or by debt or a mix of both, we'll need to wait and see.
So what's the better play, Sandeep, then from a market standpoint? I mean, if you want to play for Capex, then should you stick to, the big names like an L&T or an ABB, etc., or should you play it through financials, which has been traditional wisdom?
I think the big names of L&T, ABB cannot be the bulk of your portfolio. The advantage of playing financials is that you get not only the consumer lending, not only the corporate lending cycle, but also you get the consumer lending cycle. And on top of that, which I've been highlighting from the very beginning in this conversation, you get the the lower interest rate benefit also come through. So all told, I think financials should still be the bulk. The real question for every market participant is that whether we will see continued fiscal consolidation and responsible fiscal outlook. If that happens, public sector banks are the best place.
Okay, all right. Just hold that thought, gentlemen. We have Titan's numbers that are flashing for you on the screen, and we just have the profit number that's flashing as of now. And it appears just on the bottom line, there was a very, very small miss. Top line, I think, is fairly in line with what we're working with. For the time being, the stock is down. But I think the two numbers that we've got pretty much in line with what we were expecting. A small miss on the profitability front, and the top line, I think, is more or less in line. We'll wait for the profit number as well. Remember, for Titan, we get a cheat sheet that already comes out, an operational update. So we already have that with us. These numbers look pretty much okay, but the room for disappointment is very limited, going by the valuations that the stock is trading at. Mangalam will join us to give us a quick insight into that name. But since we're talking about, inward-facing themes, Gautam, I wanted your view on the real estate theme. We have real estate companies, the MDs, the promoters who join in, and they sound so confident, that it's just the second or the third year of this 10-year cycle that we're talking about. It breaks my heart because I can't get into a bigger home. But be that as it may, how would you approach that theme? Would you look at real estate companies? Would you play it, say, via pipe, cement, or would you go for housing finance companies? How do you play this theme if you're bullish on it?
Yeah. Fair question. I think the demand in real estate, of course, also has been aided significantly by the money made in the equity market. So it's every bull run, I've seen this in my working career, that as the bull run, I wouldn't use the word peaks, but as the bull run, at some point, people realize that maybe we should book some profit and buy a home for us, for our children, or move into a bigger home, which I hope you do also very soon. But the fact is, I think that momentum which is there in the real estate sector, which was dead literally for the last 8 years, has come back with a bang, which is the good news. And I think even today's budget, in some sense, again, it's more lower income housing. The fact is, the runway for housing in this country is huge, and it will continue for the next several years and maybe several decades. So I think from that standpoint, the real estate companies, in terms of the run-up in the stock price, has been phenomenal. Now, I was talking to, for example, one of the ceramic tile manufacturers. I'm currently in Delhi, and I was meeting some of these folks. They said that last quarter hasn't been great, but the fact is that a lot of their demand comes towards the end of the construction cycle of projects, and they're expecting the next 12 months to be actually quite good. So I think given the run-up in the real estate stocks themselves, I think cement and the building material space is where I today put money on.
Okay, all right. Got that. By the way, just take a look at Titan's numbers. The top and the bottom line didn't look too disappointing. But on the EBITDA front, there's a miss. There's closer to 80 basis points miss in comparison to our poll, and that explains why the stock is down closer to 2.5% or thereabouts. But let's get in Deven into the conversation. Hi, Deven. Good to see you in, and glad we got all of that sorted out, so we have you back with us. Your view on Maruti first. The biggest gainer, I think, today on the Nifty, it's up close to 4.5%. We had the operational numbers that came out. They almost clocked close to 200,000 units in a single month, with good growth both on domestic front as well as exports. Your view on the stock?
Hi, Nigel. Good afternoon. Well, I think the most importantly for Maruti, the product portfolio shift is definitely helping them more in the area of margin than in the area of revenue alone. And that's practically very important. As I think more amount of cars being bought, which is the SUV category, where the margins factor remains relatively on the higher side, it ultimately helps, I think, the companies like Maruti, even for that matter, even Tata Motors in this particular scenario, where I think the larger amount of optic on the SUV is basically giving them a better amount of realization in the margin. So this trend is likely to continue. As we see it, I think most of the companies are introducing the models in this category. So this trend is likely to continue. And as we see in this particular month, I think some amount of price increase taking place. Along with that, in the later part of the year, the prospects of interest rates coming down, they all are well as far as I think the likely position for the auto companies in particular is concerned. We should be seeing relatively better performance continuing in the subsequent quarters as well from most of the auto players.
Okay. By the way, just looking at global markets as well, while we're digesting, of course, all these big events here at home, gentlemen, just want to point out that European markets are still sulking a bit. There's a little bit of red and, we, of course, had that disappointment from the Fed overnight. Some of the Asian markets are weak. So in that context, I think we've done rather well. We've kind of brushed aside some of the disappointing global developments. And then, Gautam, therefore, let me ask you, what next, really? We're done with the budget. Now we move to the general election. I think the market's, going in with complete consensus on that. So what lies ahead? 2% away from all-time highs. What next for this market?
Yeah, so I think let's look at, separate two things. One is the market, one is the, underlying fundamental economy and how that's behaving. If you look at on the fund flow side, I guess the biggest concern that I've voiced over the past about 6 months or so, including on your channel, is the fact that the re-emergence of China, and that's really a concern from a FPI flow perspective. I don't think that impacts domestic flow, and that obviously remains extremely strong. I've spoken to a whole bunch of domestic mutual fund managers, and they still continue to see strong momentum in domestic flows into their funds, which is good. But on the FPI front, we've seen already in the month of January 25,000 crores of selling. China's taken in already 6 billion of net northbound inflows into those markets. So as a result, I think our concern, given where we are in terms of absolute valuation, 21 times calendar 24 PE versus China, which is about 9.5 times, I think that is potentially a concern from a flow perspective. But otherwise, I think domestically, as I mentioned earlier on this interview, that the fundamental economy is doing extremely well. I don't think domestic investors care much about FPI flows because the SIP momentum, which is there, I don't think is going to get turned off or slow down anytime soon.
You're basically saying China will do well, right, Gautam? There are some China mutual funds offering these China funds as well.
My point really is, I'm not China expert. All I'm saying is, in terms of valuation, when I speak to foreign institutional investors, they find China at this level significantly more attractive than other emerging markets.
Sorry. No, go on.
No, I was just saying that there are, I think there is Mirai runs a fund, there are a few others. But, the last time people got really bullish on China tech, that went down. There was another downturn, a bigger downturn. But maybe, at some point this year, we will see the final bottom and things will start to do better. These things are cyclical more than anything else.
And the counter argument to this India versus China thing is, India is getting premium valuations because you are giving premium earnings.
No, but the thing with China is what I was saying was that the problem is what's happening in China. And whom do you believe? Because just over the last 24 hours, you've got the Kaishan PMI numbers, which are showing third straight month of expansion. That number is above 50. Then you have the official data, which is showing contraction. So sitting here in Mumbai, kind of hard to guess what's going on.
But everything's good at a price, I think, and that's the reason why I think
it's at some price, basically. All right, gentlemen, thanks very much for joining us. Sandeep, Gautam, Deven, appreciate your time here on CNBC-TV18. It's always a pleasure. We'll move on.
Well, thanks so much for tuning in to CNBC-TV18. Make sure you follow us and stay updated on all our social media platforms.